Welcome to our deep dive on IRA contribution limits and deductibility. In this video, we will demystify how traditional and Roth IRAs interact, especially when workplace retirement plans and spousal IRAs are involved. We will also address the most common mistake people make, explain deductibility rules, and give you a clear priority framework for contributions. Let's get started. Here is today's plan. First, we will cover the single, shared annual IRA limit. Next, we will unpack deductibility basics for traditional IRAs. Then, we will highlight the spousal IRA opportunity. After that, we will look at 2024 income phase-outs. We will also give you a simple priority order for contributions. To make the rules intuitive, we will walk through a decision flowchart and 2 additional diagrams. Finally, we will wrap up with quick quizzes and concise takeaways. Before we begin, please note this video is educational and not tax, legal, or investment advice. Your situation may differ, and thresholds change over time. Always verify current year limits and consult a qualified professional. For reference, review IRS, publications 590A and 590B, and the latest IRS announcements for 2024 and beyond. Let's begin with the foundational rule. Traditional and Roth IRAs share a single annual contribution limit. This means your combined contributions to both accounts cannot exceed the annual limit. If you fully max out your Roth IRA for the year, you cannot contribute any additional dollars to a traditional IRA in that same tax year. This is the most common and costly mistake savers make. Keep this rule front and center as we proceed. For 2024, the total IRA contribution limit is $7,000 if you are under age 50. If you are age 50 or older, the total is $8,000, which includes a $1,000 catch-up contribution. Remember, this limit is combined across traditional and Roth IRAs. For example, if you put $5,000 into a Roth IRA, you can only contribute $2,000 to a traditional IRA for the same year. If you already contributed the full $7,000 to a Roth IRA, you cannot contribute any amount to a traditional IRA that year. Contributions are typically allowed until the tax filing deadline of the following year. Always confirm the exact date for your tax year. This flowchart begins by asking if you want to contribute to an IRA. The first critical checkpoint is whether you already reached the combined IRA limit for the year. If you have, the process stops, because you cannot add more to either traditional or Roth. If not, the next question is whether you are covered by a workplace retirement plan, such as a 401k. If you are covered, your eligibility to deduct your own traditional IRA contribution phases out at relatively moderate income levels. If you are not covered, your own traditional IRA contribution is generally deductible, subject to standard rules. The chart also highlights the spousal IRA path for a non-working spouse. If applicable, the deduction for the non-working spouse uses much higher married filing jointly phase-out thresholds. The flow then leads to 3 potential outcomes: a deductible traditional IRA, a non-deductible traditional IRA that requires filing Form 8606 while still benefiting from tax-deferred growth, or a Roth IRA contribution if your income allows. This decision map helps you quickly identify your likely outcome. Now let's focus on the spousal IRA, which is a powerful opportunity for households with one non-working spouse. As long as the working spouse has sufficient earned income to cover both contributions, each spouse can contribute up to the annual maximum to their own IRA. This effectively doubles the household's IRA contribution capacity and enables both partners to build retirement assets, even if one spouse does not earn income. Here are the key mechanics of spousal IRAs. First, the working spouse's earned income must be sufficient to cover both spouses' IRA contributions. Second, each spouse can contribute up to the annual maximum, which is $7,000 under age 50 or $8,000 if age 50 or older. Third, the non-working spouse's ability to deduct a traditional IRA contribution is calculated using a higher married filing jointly income threshold when the working spouse is covered by a workplace plan. This often allows a full deduction for the non-working spouse, even when the working spouse's deduction is eliminated. Finally, if a contribution is not deductible, you can still make a non-deductible traditional IRA contribution. Be sure to file Form 8606 to track basis, and remember that the investment growth remains tax-deferred. Let's compare 2 scenarios. On the left, a working spouse who is covered by a 401k faces lower modified adjusted gross income thresholds for deducting their own traditional IRA contributions. As income rises, their deduction can phase out quickly. They may still contribute to a traditional IRA on a non-deductible basis and should file Form 8606. On the right, the non-working spouse using a spousal IRA benefits from a higher married filing jointly phase-out range for deducting contributions, often enabling a full deduction even when the working spouse's deduction is disallowed. This contrast is crucial for higher-earning couples aiming to maximize tax-advantage savings. Here are the 2024 Traditional IRA deduction phase-out ranges. For a single filer or head of household covered by a workplace plan, the deduction phases out between $77,000 and $87,000 of modified adjusted gross income. For married filing jointly, where the contributor is covered by a plan, the range is $123,000 to $143,000. For a married filing jointly couple, where the IRA contributor is not covered but the spouse is covered, a common spousal IRA situation, the phase-out range is higher, at $230,000 to $240,000. For married filing separately, the phase-out range is $0 to $10,000. These numbers update annually, so always check the latest IRS guidance. Let's establish a practical priority order. First, capture any employer retirement plan match, because it is effectively free money. Second, if you are HSA eligible, prioritize HSA contributions due to their triple tax advantage. Third, if you qualify based on your income and coverage status, make a deductible traditional IRA contribution. Fourth, if a deduction is not available, evaluate a Roth IRA contribution if your income allows, or a non-deductible traditional IRA to secure tax-deferred growth. Fifth, once tax advantage space is used, allocate to a taxable brokerage account for liquidity and flexibility. Finally, for those who exceed Roth IRA income limits, explore the backdoor Roth strategy, but be cautious of the pro rata rule and consider professional guidance. This mind map centers on IRA contributions for 2024. It branches into the annual limit of $7,000 under age 50 and $8,000 for those 50 or over. The traditional IRA branch highlights that deductibility depends on your modified adjusted gross income and whether you or your spouse are covered by a workplace plan. It also reminds you that non-deductible contributions are allowed and require filing Form 8606. The Roth IRA branch notes that eligibility itself is subject to income phaseouts. Finally, the Spousal IRA branch underscores that a non-working spouse can contribute based on the working spouse's earned income, and often benefits from higher married filing jointly deductibility thresholds. This journey diagram depicts an ordered process. First, capture your employer plan match. Second, maximize an HSA if you are eligible. Third, for IRAs, confirm you have not exceeded the combined annual limit. Then, assess your modified adjusted gross income and workplace coverage to determine whether a traditional IRA is deductible for you or your spouse. Based on the outcome, select a deductible traditional IRA, a Roth IRA if eligible, or a non-deductible traditional IRA with Form 8606. Finally, move to a taxable brokerage account once tax-advantaged accounts are maximized. This journey keeps your actions aligned with tax efficiency. Quiz time. The question is, you contributed the full $7,000 to your Roth IRA for 2024. Can you still contribute to a traditional IRA for 2024? The options are A. Yes, you can add another $7,000 to traditional. B. Yes, but only if it's non-deductible. C. No, because the traditional and Roth share one combined limit. D. Yes, but only if your spouse doesn't contribute. You may pause the video now to think about the answer. We will discuss the correct answer in the next section of the video. The correct answer is C. Traditional and Roth IRAs share one combined annual limit. If you already contributed the full amount to a Roth IRA for the year, you cannot contribute any additional amount to a traditional IRA that year, regardless of deductibility status. Here is the second quiz. The scenario is married filing jointly, with the working spouse covered by a 401k and a household modified adjusted gross income of $200,000 in 2024. Can the non-working spouse's spousal IRA contribution be fully deductible? The options are A. No, because the working spouse is covered by a 401k. B. Yes, because the higher married filing jointly spousal phase-out range likely allows full deduction at $200,000. C. No, because only earned income from the non-working spouse counts. D. Yes, but only if both contribute to Roth instead. You may pause the video now to think about the answer. We will reveal the correct answer in the next section. The correct answer is B. In 2024, the phase-out range for deducting a spousal IRA contribution when the non-working spouse is not covered and the working spouse is covered is $230,000 to $240,000 of MAGI. At $200,000, the non-working spouse would generally have a fully deductible traditional IRA contribution, assuming all other requirements are met. Here are the key takeaways. First, traditional and Roth IRAs share one combined annual limit. Second, a spousal IRA can double household IRA contributions and often secures a deduction for the non-working spouse at higher income levels. Third, workplace coverage matters because it can limit deductibility for the covered worker but not necessarily for the spouse. Fourth, a non-deductible traditional IRA still provides tax-deferred growth and requires filing. Form 8606. Finally, use tax-advantaged accounts before turning to a taxable brokerage account. To summarize, for 2024, the combined IRA limit is $7,000 under age 50 and $8,000 at age 50 or older. Determine whether you qualify for a deductible traditional IRA by checking your modified adjusted gross income and workplace coverage. Make use of spousal IRAs to maximize household contributions and potential deductions. Finally, prioritize employer match, HSA if eligible, and IRAs before using taxable accounts. Thank you for watching. If this helped you navigate the IRA deductibility maze, please like the video, share it with someone who needs clarity, and subscribe for more straightforward financial guides. Tell us in the comments what part of IRA rules you find most confusing and what topics you want us to cover next.